How would you approach the banks, Nitesh? I mean, leadership over there has been undoubted, but a lot of people point out that more than inflation, it's probably going to be this frenetic pace of credit growth that the RBI will get quite uncomfortable with.
I think in the banking sector, one will have to take a longer term call. The first and the foremost risk which investors have suffered is if the regulator is lax and the banking sector ends up creating huge NPA like it happened in the Western world. To me, that risk is absent in India because RBI is quite hands-on. It has been managing this sector quite well from a regulatory point of view. So what happened in 2008 in Western financial stocks, where stocks crashed 90%, that's unlikely to repeat in India. So that gives a huge comfort. The second thing is the growth opportunity. We have more telecom subscribers than bank account holders. At some point of time, financial inclusion will result into all those markets coming into the banking sector. The third is the experience of the past in emerging markets, where when the emerging markets move towards the higher level, the banking and financial services industry grow at multiples of the GDP growth. Now put these three things together, you have a reasonably virgin market, you have a reasonably strong regulator, and you have many years of multiple of GDP growth. All these things make Indian banking sector very attractive. Now sometimes you can play in PSU bank versus private bank, sometimes you can play on valuation, sometimes you can play on large cap banks versus mid cap banks, but overall it's time to be long banking sector from a couple of years point of view rather than just looking at on a quarterly basis.
This rally has been driven by $1 billion of flows, Nilesh, over the last 1 week. You were alluding to factors like QE2, etc., and how things might pan out. What is your best guess of how the relative world of flows will behave between emerging markets and developed markets over the next 6 months, given your expectations of how things may turn out in the West?
My feeling is that at some point of time, foreign investors will again start dedicating money to emerging markets. The American markets have rallied on the basis of QE2 impetus given, on the basis of fairly loose fiscal policy pursued by their government. Now both those things are coming to some hurdle, if not end. QE2 will end by June, and whether QE3 will begin or not, we don't know. The American government has reached its ceiling on its borrowing, and they need to go to the parliament there to increase that. Now whether that will happen smoothly or not, we don't know. Eventually it will happen, but will it happen smoothly or will it put some constraints? We don't know. Now all these things will create some uncertainty about their market. The valuation gap between India and US is no longer as much as it was, say, 6 months or 8 months back. The second thing is about Europe. Investors have been getting into the European market on the basis of steps taken by European governments, but at some point of time the austerity measures which has been announced by European governments will start hitting their economies. We have seen protests emerging in UK and other European nations about austerity measures. So somewhere the government will have to probably relax a little bit of austerity measure, which in turn will create doubts about the potential debt defaults and so on and so forth. The third portion of the market is Japan, where again a lot of unfortunate events are happening, and probably it's going to drag their economy for a while. Now in this kind of scenario where most of the developed markets are going to be plagued by their own sets of problems, the focus will again come back to emerging markets, where growth, the debate is about 8% in India or 8.5%. About inflation, it's 8% growth and 8% inflation rather than 2% growth and 4% inflation. About earnings, whether it will be 15% or 20%, not like minus 5% or plus 5%. And the valuation, the most comforting thing will be valuation at about 15.5 times 1 year forward earning. Albeit it's not very, very cheap, but it's not expensive either. Put all these things together, we will see FII flows re-entering Indian market. The second thing which we can do from our side is to bring quality issues either on the IPO side or on the QIP side, and targeting investors to come into that. In 2010, bulk of the flows came towards the IPOs and the QIPs rather than in the secondary market. So if you can open the tap on the IPO side and the QIP side through divestment or otherwise, I think then the demand and supply both will meet, and we could see more FII flows entering into Indian market going forward than what we have witnessed in the first 2 months or 3 months of this year.
So what is a good asset allocation call now, Nilesh? I mean, just about a month back, everybody or most HNIs would have said, oh, give me FMPs at post-tax 10% nearly, and that's a better way to be, better place to be. Would you change your asset allocation in the light of how events have turned out since then?
I think in terms of our asset allocation, we were a little bit overweight equity a couple of months ago. Now probably we'll take a little bit of profit as market starts moving higher up. But broadly, this kind of movements are not going to not going to change asset allocation by a big margin, a couple of percentage points here or there. But I think this is the time to be biased towards both debt and equity in a fair proportion. Equity, as I mentioned, is neither cheap nor expensive. So try to invest in a falling market, try to pick up mid-cap stocks, try to pick up contra sectors. In terms of debt, again, most of the debt products in the market on the FMP side or fixed deposit side are giving between 9.5% to 10% kind of return. And mind you, last year's equity index delivered almost similar return, so that's not a bad return at all. So try to have a neutral allocation between debt and equity. 9.5% to 10% return on debt products, be it FMP or fixed deposits, is fairly attractive. And on equities, try to be contra, try to be into mid-cap biases right now. Try to buy on a falling market rather than a rising market, and that allocation should work well for next year.
Where do you think institutional investors stand on softer issues like corporate governance, Nilesh? At the start of this year, that was a big deal, the kind of overhang we had in terms of scams. Are people happy with the resolution they see, or have they decided to discount that because of the valuation and the performance, as you said, for the market?
I'll quote some of the public statements by respected foreign institutional investors, which have said that corruption is prevalent everywhere, and that's not really the big issue. What is important is how do you tackle corruption, and which is where again, my repeated point is that we are unable to market our story well. Yes, 2G scam is bad, but look at the way we have conducted 3G auction. It resulted into fair amount of money, and the process is very, very transparent. So as long as we can pass this message that yes, scams do occur, but we ensure that guilties are punished, and we take corrective action so that it doesn't get repeated, I think most investors will then be willing to let go the corruption issue at the backside and focus on the basic fundamentals in terms of growth, valuation, earnings, and so on and so forth.
Always good speaking with you, Nilesh. Thanks for stopping by today.